the truth about Stamps.com Inc., STMP. The first thing you're gonna see when you look at this company is they're a pretty sizable company. Like, they're not massive, but the market cap is $2 billion almost right now. So, I mean, that's pretty big for what they do. I mean, it's a pretty simple business model. I mean, it's just postage on demand. These guys, they do one thing and they do it pretty well. I use them all the time for my e-commerce businesses. At least I used to, and now I know for a fact that my fulfillment houses use them to print postage, basically. I mean, it's not that tough to understand the company. They got a PE right now about 35. Last time they paid a dividend was in 2010, which is kind of interesting because they seem like they're making pretty good money. But then you look at the stock chart and you start to really uncover that, like, there is some fat volatility on this stock. I mean, it's been kind of crazy. I've done 2 trades recently on Stamps, and they've both been the same. They've both been head and shoulder setups, which are really, really simple. Like, basically, you got your first shoulder, you got your head, you got your second shoulder. Usually these are kind of about the same price level, and it was with Stamps.com, so it kind of drops you to the price level. You got your shoulder line right here and your head right here. And really, really basic for these setups. All you do is you just take kind of this height right here, and just subtract that. That's your target for the price, it's your price target. And that's where you want the stock to go. So you short it here. And similarly, really, really basic in inverted head and shoulder setup, same thing, it's just upside down. So you have sort of the same basic premise, except it's flipped on its head. And really, really basic, bam, bam, bam. You just take this right here, add it on top, and then you would just buy here and sell here, right? Buy and sell. Works really, really well. It's a killer setup. Honestly, one of my favorites on the planet. And one of the reasons why is because if you look at Stamps.com, like, it just works. And it works really well. So the first setup was right here. Here was the first shoulder. Here was the head. Here was the second shoulder. Now, if you're ballsy, you can short kind of right here at the peak of the second shoulder with a stop loss, give or take, right here. And that was the play on this, guys, for the first one. That was pretty much the strat, was to get in early just because, like, they were so high, they were so inflated. I mean, it was just like, it was a great setup. And so that was the strat on the first play. So we took this height right here, and you just add that to the bottom. You get a target right about here, and that's essentially exactly where the stock price went, so it worked out really, really, really well there. And then the second shoulder, the second setup here, was a little bit less set in stone. Like, that was a really good setup. The second one was a little bit on the edge. And so basically what you're looking at is a little bit more of a contrived setup here. You got your first shoulder here, and then this is your head. And it's a really, really big head. And then you have your second shoulder here. Now, when I first saw this, I'm going to get rid of this last line. When I first saw this, the stock was like right here. And like, I saw that it was an inverted head and shoulder setup. But it's not as good. Like here, like, you've got a pretty solid shoulder, a pretty solid head. Like, they're very well separated. Here, the shoulder, I mean, it's not that big, you know, and there's a big separation between the head, but this was also our price target from earlier. So the question becomes, you know, is this a valid setup? And so what I did was really, really, really simple. I went on my phone and let me actually show you the daily chart. Let me zoom in a little bit here. This is a weekly chart. Basically what I did is I opened up the Thinkorswim app and I set a notification and I said, look, if Stamps.com stock goes above, call it 92.50 or 95, I think, yeah, I put $95. I think it was 92. I can actually check. I'll check real quick. Yeah, it was 92.50. So I put in the notification. I said, look, if this stock hits 92.50, I'm going to open it up and I'm going to buy this thing like no one's business. And so I remember I was standing in line at the post office, and I'm sitting here at the post office, just kind of waiting to get my mail, putting some mail. I had some books to ship out. And I remember I'm sitting at the post office waiting. There's like 5 people in front of me, 5 people behind me. And I get this buzz on my phone, and it's the Thinkorswim app. And like, for those of you who don't know, when you create an alert in Thinkorswim, it'll like give you this notification. And I never, ever, ever get any alerts from Thinkorswim unless it's either a trade I'm making when I'm sitting in front of my computer, or it's a notification. And like, when I get a notification, like, those notifications are straight money. Like, they are just gold. They're like, every time I get a notification, I know that it's because I saw a setup and I put in the notification, and then that notification turns into money because I trade it like instantly. I don't hesitate. Like, there are stocks I've had notifications for, like, buy this stock at $2, and I get the notification, I hesitate, well, not hesitate, like, I didn't see the notification for 7 minutes, And I remember I opened up my phone and stock's up like 15%. I'm like, you know what? This is a tough choice. I already made 10% of it, but I think I'm gonna buy it anyway. And I remember I got in that position, and the stock went from like $2 to 12. I think 12 to 8. I think it was 8. Yeah, went from 2 to 8. The high was 12, but I got out at 8. Went from 2 to 8 in the span of like 16 hours. And for the short term, it went up, hit 2, and then it was at like 220, and it came down to like 210. It never really came down back to 2 again. So like I would have been able to get in it too if I could have just been stubborn and tried to wait and I would have missed out on all that upside. So really, really important. Like if you have a setup like this, you set a notification for it. You make sure you treat that like money. So because of that, I was sitting in line. I get this notification on my phone. I drop everything. I'm holding my backpack and I'm holding like a couple of books. I think it was like 5 or 6 books. I drop everything on the ground. I run over to the nearest counter. I pull up my laptop as fast as possible. I open up, Think for Swimming. And I buy like, I think it was 2 week Sam's calls, because I knew that this shit was about to happen. It was really, really well. So I was like a total idiot, like freaking out in front of everybody, spazzing around, trying to buy this stock, trying to buy options on this stock. And I remember I get like 2 calls, like and anyway, I just ignore everything. All I do is buy the stock. Thankfully, the stock, it hit 92.50. And then it kind of went down a little bit. 92.50 was like the high of day for that day, and so it wasn't like with cheaper stocks. You sometimes have a little bit more volatility. Not so much with Sands. They're kind of more of a well-established company. But anyway, I remember. So I get in there and I buy the stock, and within like the next day it goes up a little bit. It was pretty nice, and then the day after the report is like the craziest thing ever. And within like 1 day, the calls go up like 800%. It was absolutely insane. And it completes this setup in a matter of like 1 day. It was crazy. So that right there was a really, really, really nice inverted head and shoulders setup. And it hit the target almost perfectly. So the low here was about 30, 35 conservatively, and the shoulder line was about 95 conservatively, aggressively. So that's about give or take $50. You add $50, 95, you get 145. I actually sold at 150. It went all the way up to 164, which is kind of crazy awesome. This stock is really great. The trades on here are phenomenal. Like swing trading this stock, great idea. It works really, really, really well. It's pretty sweet. Now the question comes in now, like, is this a quality long-term investment? So if you look at it over time, like, it's been performing pretty well. It's gone from like $20 to 250 in a matter of like a couple, like maybe a decade. I mean that's pretty freaking great performance. If you look at the history, it did a 1-to-2 split in 2004. So 1 share turned into 2 shares. With a big company like this, I really don't see why they would have a reverse split. I think it might have been because they used to be a $200 stock, and then they went to being a $7 stock during the dot-com bubble, which kind of sucks. And that's probably one of the reasons they did it, was to make themselves look more expensive. I'm gonna give them a pass on that though, because that was like almost 2 decades ago. It was a very long time ago. And so that's something I think we can ignore. Dividends, like again, last time they paid a dividend was a very long time ago. It was apparently like a freaking 20% dividend, a 15% dividend, $2. I mean, that's a pretty good $2 dividend on a $13 stock. It's kind of crazy. In 1 quarter, I'm sure they freaked out when that happened. That's probably why the stock went down a bunch after they paid the dividend, because that's a really big dividend. But I guess they're not paying dividends anymore. Kind of makes sense. If we look over at their financials, we can see that like this looks like a company that makes money, and it makes more money over time. Like they started at $350 million, now they're making $570 million. Like that's some pretty solid growth. And if you think about the industry, think about the sector, like these guys are in this business of shipping things online. Like that's a very nice sector. That's a good business to be in when everybody's transitioning into buying things online. Like it's just a good business. It would have been a hellstorm to start in 2000 though. I mean, I feel so bad for these guys who were investing in 2000, because that must have been a bumpy ride, going from like $7 to $35 to $9 and then up to $250 and then down to $50. I mean, God, like, I can't imagine. But I mean, these guys, they're well established. They have a great brand. Just looking at the numbers here, like, they make money. They're investing in R&D, which is great. They have normal administrative expenses. They have, $2 million in debt payments every year, which is nothing compared to their revenue. They have very little debt, and that's pretty great. I mean, everything here looks really good. They've got incomes. I mean, like, they're paying taxes, which means they're making money, which is great. If you look at their cash flow, I mean, it looks pretty great. Their company it's a pretty simple business model. They've got great net income. Used to be a little bit higher, now it's a little bit lower. Probably why their stock has gone down by like 70% or something. Just kind of, and then now it's up a little bit, so maybe down, half, I would say. Really though, I mean, it's a pretty solid company. They've got nice numbers, in almost every single regard. It looks great, like they're making money. If you look at their little chart here, they're making more money on average. I mean, they took a hit on earnings, but at least they're still profitable, right? A lot of companies don't even make money. And so they're doing like, I'd say average like $100 million a year on a valuation of, $2 billion? It's not like great, it's not a 20x multiple, but I mean, it's still like, it's reasonable. It's kind of like a tech company, kind of makes sense. Again, the PE's around 30, which, it used to be 15. It'll probably get closer to 15, especially if we kind of enter this like hesitant time, if we enter this recession. We're probably going to see that come down a little bit. But everything here looks great. The profit margin is like pretty solid, like 10% is pretty nice. 16% operating margin gives them a lot of room. Here's something cool though. Their return on equity is like 10%, which is like really good. And their return on assets, 7% almost. Like, they do a good job of turning the money they have into more money. And I know we said that they don't have a lot of debt, which is true. If we look at the balance sheet and we look at like all of the debt that they do have, you're gonna see really, really quickly that they have basically a lot of cash and they have a lot of assets, which is mostly cash, because again, it's mostly an online business. They have a little bit of plants, but not much because, it's an online business. I think a lot of this goodwill is like branding, stuff like that. So they've got assets. If you look at their liabilities, it's mostly like accounts payable and then long-term debt. And that's the thing I want to focus on here is the long-term debt's been steadily decreasing because they're paying it off, which is awesome. That's probably why they haven't had as many earnings, because they're paying off that debt. They paid off, $100 million or $100 million in the past couple of years, which is great. But I want you to still notice, like, they've got a pretty good chunk. Right now, $50 million in long-term debt, long-term liabilities. They've got a pretty good chunk of money they've taken in to invest in their business. And so what I decided to look up is I wanted to figure out like what is the actual whack for these guys? What is like if you look at every single loan that they have, every single person that gave them money, if you look at essentially all of their bonds, all right, what is the average amount that these bonds are costing them? What is the average expense of these bonds? And so I did some digging and I found this site. They said that Stamp's weighted average cost of capital is about 2%, which means that on average, like if you look at all these bonds, these are netting on average 2% to the bondholders, which means that to Stamps.com, this costs them 2%. So they're getting this money at a 2% interest rate, which is really, really, really good for a corporation. Like that's a phenomenal whack. That's like most companies are around 5, 6, 7, 8. To see these guys at 2, it says a lot about their company. It says a lot about the stability of their business and their viability. If you look at their book value is $39 a share. And again, they're a $50 stock, $150 stock, $115 stock. Like $40 a share, like that's not great, but it's pretty good. And so they've got a lot of assets, and since they don't have too much debt, I think what they've done is they've collateralized these assets. Or they've collateralized the debt. So they've put a lot of their assets down as collateral on the debt. And because of that, they've got a really, really good rate. And they're turning that money right here, according to this website, almost 10.5%. According to Yahoo Finance, about 10%. So basically, like they take in $2, right? $2 comes in from these bonds. And for every, we'll call it like just say it's like 2 million, okay? They take in 2 million. That 2 million turns into 10 million for them. Like, that's really, really, really good. And obviously this is not really 2 million, this is 2%, and this is 10%. But either way, like these are really good numbers for a company. I mean, these guys seem to be very good at multiplying their money and taking in the income they do have and turning it into more money, which is pretty great. Everything about the financials, it just looks really good. Obviously there's going to be market influences, and we'll get to that in just a minute. But before we do, I wanted to point something out that I noticed researching this stock that I was very, very surprised about. And it was that they are the number one holding, they're the number one holding in the S&P retail ETF, the XRT. And so for those of you who haven't been following the XRT, which is probably everybody on the planet because no one's investing in retail, like this ETF is doing really bad. If you look at some of the top holdings, it's like Rite Aid, Kroger, Tiffany, BJ's, and there's some Amazon. Like, I don't know why there's Amazon in here. Like, Amazon is e-commerce, but for some reason, like, they're the top weighted holding in this ETF, which is kind of interesting because they're not like a brick and mortar retail like Tiffany & Co. or Costco. So I don't really know why they're in here, but this does kind of make me a little bit fearful because like retail as a whole, like just general retail, I mean, retail hasn't been doing like that well. You've got this big shift into online, and because of this big shift into online, like retail as a whole is shrinking, right? It's shrinking, and everyone's going over online. And so it begs this question. A really good chunk, if we look at the shareholders on Stamp stock, under the statistics, about 1. Holy shit! Wait, really? 0% of their stock is held by institutions? No way. That's crazy. Is that number right? Wait a minute. Okay, I don't know why Yahoo Finance said that. That number is definitely not right. So if we look at Stamps just as the institutional holdings of it, which like the big hedge funds, the ETFs, and stuff like the Spider Retail ETF specifically, which is the one that I'm kind of most concerned about. You got about a 98% reported institutional ownership rate over here. Over here it's about a 94% reported institutional ownership rate. You got to remember, looking at the stock, that the number of shares available is really, it's only like 15 million shares. And so to see institutions holding 16 million shares here, or up to, it looks like these guys are reporting that institutions, which this might be a little bit more of a broad definition of what an institution is, but it says that there's almost 17 million shares held in institutions, which is almost all of the stock. So like give or take 90% of this company is held by institutions, and I think a big chunk of that is coming from those that retail ETF from the Spider, because it's a pretty big fund. They've got hundreds of millions under management. I think it's like 350 million. And so you turn that into 2% of that is give or take 2 million or 12 million. And so 12 million on a company with a float of 17 million shares, 100 a share, that's a pretty solid chunk, almost 1% of the actual base of the stock. And so I'm sure there's a lot of other big companies, big institutions like that. And so my fear is if this SPDR ETF is relative of what most people are thinking about in the market, how most people view this stock, then a lot of people might see this as a play on retail, even though it's in e-commerce. And a lot of people might start selling if retail starts to decline like it's been, and the market's crashing like it's been. They might dump retail, which is a pretty reasonable thing to do considering how retail in whole has been doing. And if that happens, my fear is that people who don't really know what stamps is and that are just like these big corporate hedge funds that really are just managing other people's money and have no interest in like actually learning about what the company does, and they would never like watch something like this. My fear is that those people, those individuals, will like dump this stock as part of an overarching sale of retail sector stocks, and that could create a lot of selling pressure for it. So that's one of those risks that I didn't expect to see with this stock in terms of long-term holding, but it's definitely there. And so that's one thing that worries me a little bit. It's not like massive, but it's definitely something to be looked at. I mean, the stock, there's only 15 million, right? And so this number, I don't know how come this number says 0. It's definitely not right. But there's a little bit of fear, and that fear is kind of, it comes up and it's shown in the fact that 27% of the of the float is short. Like, that is literally the highest percentage I have ever seen on a stock in my entire life. That means that for every 100 people that own this company, 27 of those people are shorting the stock. I mean, that is huge. That is massive. Oh my God, that's humongous. And so a reason that it might be so big is because the stock literally just tripled in the matter of like 4 or 5 months. So I don't think it's normally going to be that big, but definitely, like I made a lot of money on the upside here, so I didn't really want to bother with the downside. But I could have bought puts, I could have shorted it, and at 150 to 115, I mean, those puts have easily gone up by a factor of 6, give or take. And so there's a lot of money. So they're probably, I think that's a little bit inflated just because of the price being a little bit high right now compared to these moving averages, and also just because of the overall market right now. But what's interesting is you've got a really, really nice monthly MACD crossover here. So as long as this price can stay above like the mid 80s, which I think is a pretty reasonable place for it to go to, maybe like 90s, as long as it can stay high enough that like this blue line on the MACD stays above this orange line on the MACD, you should, this should do pretty well. It should handle itself pretty well. A lot of that depends on like how severe the coming recession is, but let's take a look at the underlying financials and figure out maybe how the viability of this company really is. Look at how viable this company really is. The first thing you're going to see is them basically talking about their business and what they do. Basically, they sell shipping solutions online for the U.S. and in Europe, which is good. That's cool. Definitely a solid, global play. They've been around for 2 decades plus. I mean, they do good stuff. Their target clients are basically brands and people that sell things on the internet and need to ship things. I mean, it's not that difficult. They have a lot of really great high volume stuff. I know this from fact, like warehouses, fulfillment centers. I mean, they're big. They're everywhere. They're from the bottom to the top. They're servicing everybody in the market, and they're basically like one of the only people that does this. I mean, it's a pretty small number of players that do what they do, and so they control a pretty significant chunk of the market. They're one of the only players, which is really nice, but at least the public ones. And so there are a couple of risk factors, like, if people stop sending things over the internet or stop trying to print shipping labels at home, nobody's going to use our company or use our business. For those of you who aren't familiar with stamps.com, basically the way it works is you pay a certain monthly fee, and then you pay the postage. The postage is just whatever the postage costs. You don't pay any extra for the postage. and they make the money on like their monthly fees, and it's like a subscription model. So they get solid recurring revenue, which is why their valuation is likely so high, because a very large chunk of their revenue, almost a lion's share of it, like it's basically all recurring revenue. And so because it's all recurring revenue, like their stock, it can be valued a little bit higher because recurring revenue is worth more in terms of valuation, quote unquote worth more, but the multiple on it is higher because it's like, I'm not going to ever stop paying stamps.com, or the people I work with are never going to stop paying stamps.com because their business will go out of business if they don't have somebody to print postage with. So it's like they've got great numbers when they have clients that are succeeding with doing anything where they need to ship things. You can see the company's been doing really, really well compared to the benchmark up until lately. So like that's a great indicator. That's a freaking cool sign. That's what you want to see with these guys. You can see kind of their financials here. We already looked at their financials. But it's interesting to see they do have this thing they do called customized postage. It's a pretty small part of their revenue. Most of it really does just come from mailing and shipping. I mean, that's basically all they do. And then there's obviously the cost behind what they do. You know, they have to like actually operate a functioning online company. And they do a bunch of marketing, which is great. I mean, they're investing in their business, which is really the goal. And that's all. You want to see sales and marketing, which is great. Research and development is great. And then it's just basic admin, which is about, you know, a little bit less, maybe 70% of the cost of revenues. Like, these guys are managing their business very, 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 very well. And they're making money. I mean, that's basically what matters. They've got shareholders' equity, almost 600 million in shareholder equity right now, which is great. It shows that the company is still in the positive. Even after such a massive decline in the stock price, they're still worth a lot. And they still have a really, really, really solid chunk of value that they are basically just leaving on the table and leaving for shareholders. So even though they're not paying dividends, like they could very, very easily pay dividends. I don't think it's that big of a deal. Like dividends not going to be that much. It's not going to make that big of a difference on a stock that moves 50% in, you know, a week or two. But the important thing here is sometimes you have stocks that don't pay dividends. They don't pay dividends because they don't have any money, and that does not appear to be the situation with stamps.com. Like they got plenty of money, and really they're doing something really smart. You'll see a lot of companies, there's kind of like three main stages of most companies, right? You've got your first stage, which is like startup, okay? And this is like, you know, before they go public, they're like just starting up, and basically they're scraping by, they're trying to make their business succeed, and they're putting everything they have in here. So they've got a little tiny bit of money, and they're just getting by on everything they have. And all the profits they make, everything gets reinvested into the business. And so because of that, you're going to have basically a $0 dividend. Sometimes the founders aren't even going to pay themselves at this point because they're just trying to bootstrap the company, which is like, that's like normal for especially for internet guys in like the 90s. I'm sure that these guys probably got capital early on. And so that moves us on to the second stage. This is early stage, okay? And with early stage companies, what's cool about these guys is this is where your company, or whatever company you're investing in, they're constantly reinventing themselves. They're constantly innovating. And what they're doing is they're taking the money that they make, and they're making good money, and they're reinvesting it into themselves. They're reinvesting it into R&D. They're reinvesting it into new technologies. They're reinvesting it into just doing things to make the company more profitable in the future. And this is really, really good. This is like this is like the golden zone of a company. This is where you basically want to perpetually be. Like, just get rid of early after a good amount of time, but you want to be innovative. You want to be doing new things. If you look at a stock like GE has gone up, and then down, and then up, and then down. They've had these massive fluctuations because they were innovative here, then they stopped being innovative. Then they were innovative here, then they stopped. I mean, it's not that difficult to understand. This is a company that is trying to improve themselves over and over again. And because of that, they don't return money to shareholders, because when you're a company that can get a 10% return on capital invested, it doesn't make sense to give that money to a shareholder for a 1% or a 2% dividend. It just makes no logical sense. It makes way more sense to keep reinvesting into the company when you can have such a phenomenal return on the money that you have. And that's exactly what Stamps.com is doing, which is great. And then the last stage here, this is like the late stage company, right? And these are companies that basically they make a bunch of money, and like they just want to basically keep all the money that they make, and they don't really care that much about growth. You'll see companies like this pay out dividends, and the dividends will be like 90% of their profits, sometimes even over 90% of their profits. They'll pay like, you'll see companies, they pay like 100% or 110% dividend payout ratios because they're paying out money they literally don't even have to their investors. And this is really what happens when a company has kind of reached sort of this high point, and because it's gone up so much, like the people who started it, they just want to take all the money out of it and just turn that money into their own money. So they can go home and they can buy their yachts, they can buy their new houses, whatever they want. They want to go home and be happy and just take that money and give it to themselves instead of creating a bunch of value for the shareholders of the company, which is like the real, that's the real payoff, right? So you'll see this with really big guys who just want to take a bunch of money out. These are companies that have profitable, proven systems. They have really, really effective ways to make money, and then usually these guys, since they're late stage, they're making a lot of money, like billions, trillions. They're crushing it. These are the companies that maybe they don't need to innovate as much because they dominate a market and they are like the only player. You're going to see companies like that have really, 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 really high, like massive dividend payout ratios, and they're just going to pay really, really high dividends. And like this is great, if you're trying to retire and you need to have like a portfolio that's stable and reliable, and all you want is dividend income, blah 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 blah. That's cool. If you want to make like 10%, or not 10%, like 2 or 3 or 4% in a year off of dividends, like these are, great. Invest in blue chip stocks, whatever. But if you want to like double your portfolio in a stock that will go up by a factor of 3 in the span of like a month or two, like this is really kind of your sweet spot where you've got innovative companies. They're not as risky as startups where they're not really as proven, but they're not as, I hate to say obsolete, so I'm going to say like slow instead, like slow moving, as maybe something like a Coca-Cola, something like a blue chip stock where, like there's definitely growth, but it's just kind of incomparable it's just not that quick at all. So this is kind of like your Goldilocks zone in between the two, where you have a stable company, and so the point here is that when you're in this Goldilocks zone, where you have a stable company that it's not like obsolete, and they're like doing new things, trying new things, and they have potential for more growth, and they're really, 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 and there are obviously exceptions to this rule, there are exceptions to this, but this holds true with a vast bulk of stocks. This is where they're going to be reinvesting cash into themselves, and therefore not paying a dividend or paying a very, very small dividend payout ratio. And so that's really where you have Stamps.com right now, is they're not paying out a dividend because they just do such a great job of investing in themselves. A great little way to think about this in your own life. I have tons of students, and all they want to do, like, they're so kind. They want to take all their investing profits and they want to like donate it to kids in Africa. They want to donate it to building wells in faraway places. They want to donate to all these charities. And I'm like, that is awesome. That is so cool. That's phenomenal. And then they come back to me in 2 months and like, oh my gosh, I just like made 40%, or I doubled my portfolio, or I crushed it, or stuff like that. And I'm like, that's awesome. Do it again. Like, no, I want to donate this money. And I'm like, dude, if you could just do that like 3 more times, like you could donate so much more money, because you could make way more money. And then, like, if you think about it, like, if you give your money over to someone who doesn't know how to invest, really, really good 90-day traders. If you give your money to someone who doesn't know how to multiply it, like, I feel like you're doing them a disservice if you do know how to multiply that money. Like, if I have, like, $10,000 and I could give that to a charity tomorrow, like, that's awesome. But that charity will go and basically, like 99% of charities will go and they'll spend it on whatever the charity does, right? They'll do whatever the charity does, and it'll get, $10,000 worth of value in that charity. But if I can take that $10,000 and I can put another zero on the end of it by buying some freaking stamps calls or whatever, or making smart investments that are like quality, diversified, quality investments, whatever. If I can put a zero on the end of that number and I can give a charity now $100,000, now they can do $100,000 worth of things with it. They can do 10 times more things and get 10 times more value out of that donation. And so that's exactly what you see here with Stamps.com. Like, it doesn't make sense for them to pay out a dividend, because if they just keep the money for themselves, they can multiply it so much better than the shareholders. And to kind of like steal quotes from like the really early Wall Street movies. Like I think it was like Wall Street 1989 or something, 1987. The guy said like other, or maybe it was also in the Wolf of Wall Street. The guy, the Wolf of Wall Street, also the Wall Street guy, said other people's money is better spent by me. And so I want you to think about it like other people's money is better invested by you. Or for in the case of this company, other people's money, which are the investors' money, like the money, the profits the company makes, are better invested by stamps than through dividends of the people that are holding the stock. And so that's really the mindset, the mentality that that they have behind, I think, retaining a lot of their cash, is they just do such a great job of investing and multiplying it. It's really impressive. They just do a great job. Now, with that said, they talk about their risks here. They got credit risk. I mean, they're holding a bunch of cash. Obviously, they have a little bit of institutional stuff just because they're operating internationally. They have to do currency exchanges. I know the British pound has been down a boatload since the crash started, so we'll kind of see how that. But I mean, it's like it's a couple of percentage points off of their top line. It's not that big of a deal. They can translate it into whatever currency they want to transfer. I mean, it's not a big deal. They have to pay taxes. They have to pay leases. I don't know what they have in terms of inventories. I know they send a bunch of scales. Like I have some of their scales. They send people scales. It looks like they have about $4 million in inventory, which is like super tiny for a company that this big. It's a $2 billion company. Like that's almost nothing. My guess is that that's basically like the scales that they ship out to people. Because I know they sell scales. They also sell a little bit of stamp stuff. Like they have like stamps. Like they'll mail out direct mail stamps. They'll like send out. I've actually gotten a ton of marketing stuff for them, which is why they have so much of my money. Like they have just like the paper stamps that they'll mail to people, like adhesive sheets. And so they send out a lot of that stuff. And so I'm guessing that that's probably what their inventories are, which is mostly marketing expenses, like get a free scale and you sign up and get free postage and stuff like that. So that's kind of what you get with this company. Is really basic, dry cut. There's not much to hide here. Like, they got some stock compensation here. Fine, that's great, super cool. About $2 million, $40 million in compensation. And I mean, they do a good job. It's a solid company, and there's not really that much out. They got great projections. They got great, amortization and depreciation. They're doing smart things with their accounting, and just all around, they're a pretty solid company. There's not much else to say about it. I mean, you can really dive deep here, but you kind of see basically, bulk of their business comes from the United States. And so really that transitions me into the last thing I want to talk about with this stock, and that is basically acknowledging that this is, by almost every account possible, this is a market play. If you look at their history, basically they IPO'd in like 1988, they went up during the dot-com bubble, then they crashed after the dot-com bubble, and then they went up before 2008, and then they crashed during the housing bubble. They went up during the previous bull run, and then they crashed sort of as we start to enter the recession. And so really just at a fundamental level, like this is basically a market play. And they could be the best company in the world, but if the stock market crashes, like they're gonna crash with it basically. And they've already, they've basically already gone down a whole bunch. It's not like there's anything new here. But that's really what we're looking at here is this is basically a market play. And if the market goes up, they'll probably go up. If the market goes down, they'll probably go down. If we add a comparison here, I'm going to compare it to the NASDAQ because it's a tech stock and it makes sense to compare it to the NASDAQ. And I'll change this over to a line chart so you can see it a little bit easier as the comparison. But basically, like, you just want to be looking at timing with this position. Here we can see stamps.com is the dark blue line. And if we zoom out a whole ton, they haven't really outperformed the NASDAQ that much, only recently. That's probably because they IPO'd at a really high price, and that was 2 decades ago. So I'm going to zoom in just a little bit. And when we zoom in, we realize that like these guys have really been crushing the market. Again, here's their stock in blue. They've pretty much outperformed the NASDAQ in the entirety of the 2000s. They stumbled a little bit during the crash, but after the crash, I mean, the NASDAQ went up 300%. These guys went up, 1,500%. And I mean, just looking at it generally, only recently have they come down to the low levels of what the NASDAQ's been doing. And if we compare it to the S&P, it's going to be like night and day. Like these guys are going to blow these guys out of the park because the S&P is just going to be lower than the NASDAQ. But basically, like this is a really good stock. I mean, they just have been performing extraordinarily well, and they do it over and over and over and over in tons and tons of time periods. It looks like they were struggling a little bit when they were starting off, which sucks. But now that they've become an established company and basically the only sole player of the market that they dominate, like they're a phenomenal company. Obviously, there's risk here. Like if somebody else comes in tomorrow and starts doing exactly what Stamps.com is doing, their stock going to tank, and they'll probably have a lot of struggles over the next couple of years, over the rest of their company. Like new competition in this space is one thing that could really hurt them. But to be honest, like it's difficult to enter this market. Like it's a pretty high barrier to entry to selling postage online. Like that's just a tough market to get into from what I know. Like you've got to have partnerships with USPS, you got to have partnerships with the shipping people. Like there's a lot to do to make that happen. The only person I would watch out for, and the company's not public, is ShipStation. And ShipStation literally integrates with Stamps.com. They're not a public company. They're maybe one of the only people I could see ever entering this marketplace and ever doing what Stamps.com does. But ShipStation, like basically, like they just try to integrate Stamps.com with other platforms for e-commerce. And I use them, they're great, but they're not Stamps.com. And I think that's really the big takeaway here is you can look at tons and tons of other companies, but at the end of the day, they're not Stamps.com, and no one will ever be Stamps.com except for Stamps.com. And so unless someone comes in tomorrow and does the exact same thing they're doing, these guys have a really great hold on the marketplace as a whole. Now with that said, if the market crashes and it goes down a bunch and people stop spending as much for a small chunk of time during a recession, like they're going to suffer because there'll be less online shopping for a small chunk of time, and the stock will probably go down a bit for a small chunk of time. I personally don't think these guys are very well valued right now. I would say, and I kind of biased because like I said, I just sold the stock very recently, but I think they'll probably go kind of more towards their 50 or their 100 monthly moving average, or their 200 monthly moving average, which is this orange line and this red line. They probably have a little bit more time left to go down. Like I said earlier, about $80, I think is a reasonable target. They might dip even lower. Like it depends on how bad the market crashes, to be honest. It could go to 64. But I mean, it just depends on the market conditions. Really, this is a market play, right? So I mean, as soon as the market bottoms, I think this is going to be a really great addition to any kind of portfolio, just because they're a solid company and they do great stuff. And right now they're kind of pricey, but I mean, if they could go down a whole bunch again, I would probably definitely swoop some of this up as long as the MACD looked good. And the stochastics look good. I mean, but besides that, there's not much else to look at with this stock. Like they used to struggle, they used to have a difficult time because it was an older company. But like now, looking forward, they're one of the only players in their space, and they do a great job of making money. And like, what else could you want from a company? The last time the percent B was this low was in 2008. So I mean, as soon as I think this might have been the bottom, which is why I bought it, and it was inverted head and shoulder setup, blah 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 blah. I don't know if it'll go all the way down to the 200 moving average on the monthly again, but I mean, just all in all, this is a solid company. And so hopefully, if a lot of these big ETFs start selling off the stock, that'll drive the price down, and you can get it while it's really cheap, and just hold it for capital gains. And I mean, you're looking at a really solid position here. And if you see any setups on it, like this stock has done two really great head and shoulder setups in the past year. So if you see a setup on this, I would highly recommend trading the options on it. The options on this have a leverage multiple of about 15x. So a dollar move in the stock is about a 15x move in the options. I mean, just from experience, they are. I mean, I woke up one day and my position in this is up by like 1,000%. I mean, it's just a really good company to invest in for swing trading and also for long-term investing. In the short term, it might be a little bit overvalued. But I mean, unless someone comes in and just copies their company, like these guys are very well positioned for some long-term growth. I mean, especially considering the growth of just online commerce in general. Like these guys, I mean, they are very well positioned to take a big chunk of that profit, to take a big part of that growth out of that sector, which is growing. I mean, how fast is the online market growing? Like how much more people buying online? It's just growing up and up and up and up and up. And I think hopefully that should translate into some gains and thus the stock price of stamps.com Inc., which is really, really cool. So I think that's probably the big takeaway from here, and a really, really good one to have on your portfolio watch list, because these guys are pretty sweet. I think I have them in like my dude watch list, which is like my super secret like explosion stock watch list, and they have very well held up to that name. They're a pretty solid company, so it's really, really, really cool stuff.